Hi guys, today's video is focused on IAS 2 inventories. So guys, as always, whenever we are talking about an international accounting standard or international financial reporting standard, we need to know the scope of the standard. Means what it covers. What are the areas which are covered under IAS 2? So IAS 2 covers inventories, their cost, how they are recognized, how they are de-recognized, what is their measurement criteria, and so on. What is not covered by IAS 2 is financial instruments, which are covered under IAS 32 and IFRS 9, and biological assets, which are covered under IAS 41. So IAS 2 covers inventories. So here we need to understand what is meant by inventory. So my definition of inventory is something which is available. For example, we have different types of inventory. If I say inventory of raw material, that means it is available for use in production. If I say inventory of work in progress, WIP or GIP, that means goods in process, that means it's available but incomplete, in process. If I say inventory of finished goods, that means it's available but not sold and waiting for customer. The last type is materials or supplies available to be used to offer services. One thing everybody should understand is that whenever we are talking about IAS 2 inventories, our focus is on inventory of finished goods. That means inventories of goods which are available and are to be sold. In other words, we can say items which we either manufacture or purchase for the purpose of selling. That is known as inventory of finished goods. For example, if I purchase furniture from a manufacturer, why am I purchasing furniture? I am purchasing to sell them later. So that would be my inventory because I deal in buying and selling of furniture. The other way we could look at it is, what if I am a manufacturer myself, but I manufacture furniture for what? Not to use it myself, but to sell. So whether I manufacture or I buy, if the purpose is to sell, that becomes my inventory of finished goods. Now the other aspect in the standard IAS 2, we have to look at how inventories are measured. So IAS 2 recommends that inventory should be measured at lower of cost or NRV. Lower of cost means the cost of purchase, and there are different other costs which we will talking about, and NRV means expected selling price minus expenses necessary to sell. I will be doing a detailed example, a numerical example, to explain you the concept of NRV. When we talk about measurement, it is measured at lower of cost or NRV, which stands for net realizable value. Now, when we say cost, what is included in cost? First of all, cost means cost of purchase. So if I'm buying furniture from Mr. X, let's say I'm buying it for 20,000 US dollars. So my cost of purchase is what? 20,000. Now these cost of purchase may also include some delivery charges, freight, transportation in, carriage in. Means if I buy furniture from a distant place, obviously I have to bring them to my destination, to my warehouse, to my sales outlet. So cost of purchase would include cost of buying furniture, paying for transportation, any sales tax, any non-refundable sales tax, obviously exclusive of any purchase discount. If you are buying or importing our stuff from another country, so cost of purchase would also include some necessary import duty and custom duties. When we say cost of conversion, means what if we are the manufacturer? We are manufacturing furniture. So here cost of conversion would include the cost of direct material, direct labor, cost of variable overheads, cost of fixed overheads, and what if we have subcontracted some work? That would also be included. For example, I am manufacturing furniture let's say tables, wooden tables, but the top of the table is made up of glass, and that glass is manufactured by somebody else. So I have subcontracted a part of my finished goods to X company. So whatever they charge me, that is included in cost of conversion. Whatever they charge me for making the glass top, that is included in the cost of conversion. Ideally, normally, cost of conversion will include direct material, direct labor, variable production overheads, fixed production overheads. Now, don't ask me what about indirect material and indirect labor. That all is included in overheads. You should be knowing. I have made a detailed video on cost and cost classifications. You can watch that video. It's appearing here, and that will give you a clear idea about what is direct material, indirect material, so on and so forth. Now, the third element in cost is other cost. These are costs related to bringing the inventory in its present condition and location, which is not included in the purchase cost. For example, as I already told you, if it is not included in the purchase cost, if freight is not included in the purchase cost, it could be part of other cost. What if we are manufacturing a table as per a specific requirement of a customer, like a customized product? So anything in that case, generally we make table of type X, but if you are making table of type Y on a customer's request, anything to convert a table of type X to type Y would incur some additional cost, and that would be part of other cost here. The other area which is important in IAS2 is how to determine cost. So most of the time the cost means the actual cost of production or the actual cost of purchase, but sometimes some companies also use standard costing. Means what should be the ideal cost to make a table, how much material should cost, how much labor should cost. We are not talking about actual, we are talking how much it should cost. That is a standard cost. Some company use retail inventory method to calculate the cost of inventory, that is from sales. When they minus a particular percentage of gross profit, they are left with the cost. One of the important areas at IAS2 is the inventory valuation systems. We all know that we have periodic and perpetual system. I've already made a video on periodic and perpetual system. You can watch this video when you have time. But what you need to understand that whether it be periodic system or perpetual system, we also have methods under each system, like first in, first out, last in, first out, average costing. What we need to understand that in IAS2, the recommended method is that inventory should be valued either using first in, first out or average costing. Last in, first out is not recommended by IAS2. Now guys, I'm doing a numerical example to explain you how inventory is valued using lower of cost or NRV. So let's have a look at it. Here I've given you a question. There is a company which has 3 different products, alpha, beta and theta. Selling prices are given for all 3 products. Cost price means purchase price is given. Expenses necessary to sell is also given. Advertising expense for each is also given. Number of units we have in inventory for each product is also given here. Now we are asked to calculate cost of inventory as per IAS2, which is lower of cost or NRV. First, let's calculate their NRV. For NRV, we need to know what is the selling price. So selling price is given to us as 60, 24 and 44. So I'm just copy pasting here 60, 24 and 44. Now we need expenses necessary to sell. Now we look at expenses necessary to sell. So if you look at this, these are all expenses necessary to sell. This could include some modification costs or advertising costs. So for alpha, the total expenses necessary to sell is 14. So I'm writing here short form expenses necessary to sell. For alpha, it is only 14. For beta, it is 8. And for theta, it is 20. So when I subtract this, I will get the NRV. So 60 minus 14 is 46. 24 minus 8 is 16. 44 minus 20 is 24. So we have NRV. The next step is to compare it with cost. cost is given to us here, 40, 18 and 24. So cost is 40, 18 and 24. So what we have to do is we have to compare the cost with the NRV, and obviously we got to take the lower. So here if I write lower of cost or NRV, L is for lower, cost or NRV. Cost is 40, NRV is 46. Which is lower? 40. Cost is 18, NRV is 16. Which is lower? NRV. These are both the same, so I can take any. So once I've taken the lower of cost and NRV, the last step is to multiply it by the number of units we have. So we have 400 units of alpha, 300 units of beta and 600 units of theta. So I'm just multiplying by the units. Into 400, into 300, into 600. So this will give you 16,000. 16 into 300 will give you 4,800. And 24 into 600 will give you 14,400. In the end, you add all these three, 14,400 plus 4,800 plus 16,000. This gives you the value of your ending inventory at lower of cost or NRV. This is your value of closing stock. And it is at what? It is at lower of cost or NRV. Now the next important point in IAS2 inventories is the disclosure requirements. Now, financial statements should disclose the following. Number one, the accounting policies used to measure the cost of inventory. Number two, financial statement should also show the total carrying amount of inventory and its classifications. Financial statement should also show the carrying amount of inventory at fair value minus cost to sell. Financial statement should also show the amount of inventory recognized as expense during the year. Now, what does this mean? Please understand, inventories are initially recognized as assets. Until they are sold, then they are de-recognized as assets and recognized as expense or cost of goods sold. So this is what they are telling you. Amount of inventory recognized as an expense. In financial statements also need to disclose and show that the amount of inventory which has been written down as expense. Sometimes what happens, because of economic reasons, you have to write down the value of inventory. Let's say the inventory is valued at lower of cost or NRV at 5 million, and because of some economic reasons or war situations or XYZ, you have to write them down to 3 million. So 2 million is directly charged to profit and loss. So that is what it is talking about. Then financial statement should also show if there is any reversal of write down. Means if we wrote down by 2 million and later on the inventory value, or because of economic reasons it went up by 500,000, then you can reverse the write down. But that has to be disclosed in the financial statements. Financial statement should also show what were the circumstances which led to the writing down of inventory or reversals in any case. In the end, financial statement should also show the carrying amount of inventory if they are pledged as collateral for any liabilities. Ladies and gentlemen, if you have any other questions relating to inventory, or if you like this video, please comment in the section. If you are not yet subscribed to my channel, please subscribe to my channel and show that you support my channel and my work. If you like this video, please share it with your dear and near ones so that others can also benefit. Thank you so very much for your precious time.